I've been calling into question the durability of NVIDIA's artificial intelligence growth on all of my asymmetric investing outlets over the past few months. And in large part because the market is really pricing in a ton of growth for the company, the continuation of extremely high margins for NVIDIA, and they're treating it as if this is the only company that can make artificial intelligence chips. It's the only company capable of creating the models that we're using on a potentially day-to-day basis. It's the only company capable of doing the inference that's needed at scale. But that's simply not the case, and there's a couple of reasons for that. One, there's another huge player in the market, that is Alphabet. Alphabet has been doing a lot of its own artificial intelligence work for over a decade now. It's creating its own chips called TPUs. And we found out yesterday that Apple actually used Google's TPUs to train its artificial intelligence tools. Now, this is important because Apple is likely going to be the first company to bring artificial intelligence to hundreds of millions of people on all of its Apple devices starting sometime this fall. We knew previously that the inference that Apple was going to be doing was going to be either on device or in the cloud using Apple chips. These are Apple chips that were not necessarily designed for artificial intelligence. They were actually designed for PCs, but they are apparently good enough to be able to do the inference in Apple's data centers. Now, some of those calls that are going to be going out to a company like OpenAI, those would likely run on NVIDIA chips. But this is important because Apple's ecosystem is not reliant on NVIDIA chips. And as inference moves from the cloud to devices, who are the two companies that are creating the most devices, that have the biggest ecosystems? Those two companies are Apple with iOS and Alphabet with Android. So if iOS and Android are trending towards chips that are made by either Apple or Google, that is going to be a huge market for artificial intelligence inference that is going to move away from NVIDIA and the inference that's done in the cloud today and onto device through non-NVIDIA chips. And we also know that the training that's going on with these two companies, at least with all of the most recent models, are not done on NVIDIA chips. So I think this is much bigger news than a lot of investors think because some of the leading companies in AI are not using NVIDIA. So that's really notable. I'm going to dig in through exactly what we know today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get into the news reports from yesterday. I saw this first reported from CNBC, but this actually came from a technical paper that Apple put out that two new artificial intelligence models underpinning Apple Intelligence were pre-trained on Google designed chips in the cloud. Those would be the TPUs that I mentioned earlier. They go on to say that Apple's decision signals that at least some big tech companies may be looking for alternative to NVIDIA's GPUs when it comes to AI training. This has, I think, been the bearish case for NVIDIA for quite a while now, is that none of these big tech companies, which are a vast majority of NVIDIA's customers right now, are going to want to be reliant on NVIDIA for chips in the future. They're going to design their own chips. They're going to support AMD or Intel getting into artificial intelligence chips. In this case, this is Alphabet and Apple designing their own chips that are going to be used in artificial intelligence, TPUs, and then Apple Silicon as well on device. This is, I think, important based on comments that we heard from recent conference calls. Sundar Pichai on Alphabet's conference call basically admitted, hey, we may be over-investing in artificial intelligence, particularly buying NVIDIA chips, but we would rather over-invest today rather than lose this market long-term. Mark Zuckerberg has said similar things. They have not reported their earnings as of the time that I'm recording. That may be out by the time you see this. But it seems like everybody is willing to over-invest, especially these companies that have almost unlimited balance sheets. They're willing to write $10 billion checks to NVIDIA to foreclose the potential competition. So this is the state of things right now in artificial intelligence, is that NVIDIA's biggest customers are the big tech companies. And the big tech companies have shown, with this deal in particular, that they are very interested in finding alternatives to NVIDIA's market dominance. The other thing I can't stress enough is that it seems like the model creation is starting to hit a wall. There's not an exponential growth curve in the ability for these models to get better and better over time. We're running out of data to be able to build these models off of, especially the LLMs in particular. So that may lead to a pullback in spending, not only by the big tech companies, but also by startups. And the other thing that is going to be extremely important in the future is going to be the inference. Where does that computing actually happen when you make some sort of call to an AI model? Is it going to be happening in the cloud? Like almost every single AI inference is today, or is it going to be on your device? And we've seen from Apple, from some of the devices made by Alphabet and some of its partners, that those are going to be moving onto the device, whether it's a smartphone, whether it's a computer, whether it's a tablet. Those inferences, especially if they're using the data that you have on those devices, are going to be moving onto the device and out of the cloud. So both of those things are going to be negatives for the overall demand for NVIDIA chips long term. And the financial implications here are absolutely astounding given the growth that NVIDIA has seen, the margins that they've seen, and the multiple that the stock trades for. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So I want to put the optimism that the market has put on NVIDIA into a little bit of context with some of the numbers. And multiple things can be true here. It can be true that NVIDIA has built a phenomenal business in compute and networking, as they call it in their segment breakouts. It can also be true that the growth and margins that they have in that business are not sustainable long term, and that the price that investors are paying is too high. So let's go through some of these numbers. The two columns, the green column is column and networking computing. That is basically the same as their data center number that they report. The blue column is the operating income. So you can see that the operating income from that segment is an incredible 71%. That's not gross margin. That is operating margin for the compute and networking segment. That has helped drive operating margins for NVIDIA overall from somewhere around 20 to 30% historically. If you go back to 2018, peaked at about 33%, peaked again in 2022 during the crypto bubble at 37%. Now that operating margin has basically doubled. So you have high revenue growth and you have high margins. Are both of those things going to maintain? I don't think they are. I don't think these margin levels are sustainable long term. It's just the cyclicality and competitiveness of the market. But investors are paying for the stock as if they are. The price to earnings multiple, as you saw in that chart, is at 61 right now. That is on a trailing 12-month basis. Now, a lot of investors like to look at the forward multiples, but those are analysts' estimates or guesses at what the future is going to look like. And I think what we're seeing on the ground is that big tech companies are doing everything that they can to not be reliant on NVIDIA chips long term. At the same time, we have questions about how much demand and what use cases artificial intelligence has in the future. The estimates are that there's been $50 billion invested in AI infrastructure and only about $3 billion in revenue. That's not sustainable long term. So call this a bubble, call this unsustainable, call it overvalued, call it whatever you want. It seems like something is significantly shifting with what's going on in artificial intelligence today. And the big things that I think are notable about this announcement in particular is that two of the biggest companies in artificial intelligence that are bringing it to consumers are not using NVIDIA chips. They are using their own chips. They are also leading the move of inference from the cloud to the device. And those devices are not going to be using NVIDIA chips. So I think long term, that is going to put NVIDIA in a much tougher position than they're in today. Doesn't mean that it's not going to be a phenomenal business, but it does mean that it's maybe not going to be a business that's worth $2.7 trillion, which is the company's market cap today. So that's really my question is, what should the business be worth if these margins start to come down to a more sustainable level, like 30, 40, even 50%, and if growth slows from where it is today? I think this is something investors should consider. But let me know what you think about Apple and Google's moves in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.